Sir, you may start.
Good afternoon to all of you students. And we have started with the foreign exchange risk management in the last class. And we are going to discuss certain questions and answers so far this foreign exchange risk management is concerned. Now, please look into question number 1. It is given the price of a bond just before a year of maturity is $5,000. Its redemption value is $5250 at the end of the set period. Interest is $350 per annum. The dollar appreciates by 2% during the set period, and we are required to calculate the rate of return. Now, we are going to assume two cases. Firstly, number 1, if investor is US investor, then there will be no impact of appreciation in dollar. And the second one, if investor is from any other nation other than US, say Indian, then there will be impact of dollar appreciation on his returns. First, we shall compute return on bond, which will be common for both investors. So, return will be calculated based on the formula price at end minus price at beginning plus interest, entire thing divided by price at beginning. So obviously 5250, we are replacing, we are substituting the values 5250 minus 5000 plus 350, and if entire thing is divided by 5000 and if it is multiplied by 100, then the return comes to 12%. Now, for US investor, the return shall be 12%, and there will be no impact of appreciation in dollar. Now, as per the second assumption, if dollar appreciate by 2%, then return for non-US investor shall be return multiplied by 1.02, that is 0.12 into 1.02, or it is coming to 0.1224, that is 12.24%. So, based upon the assumptions, the answer will be done, and we did the answer based upon two perceptions. Remember, one is if investor is US investor, then there will be no impact of appreciation in dollar. But if investor is from any other nation other than US, say Indian, then there will be impact of dollar appreciation on his return that we have witnessed from the solutions. And by the by, if dollar appreciate by 2%, then return for non-US investor shall be return into 1.02, that is 0.12 into 1.02, it comes to 12.24%. Okay, now we are coming to the second question. ABN AMRO Bank, Amsterdam, wants to purchase rupees 15 million against US dollar for funding their Vostro account with Canada Bank. So I'll tell you what is the meaning of Vostro account. That is, ABN AMRO Bank, Amsterdam, wants to purchase rupees 15 million against US dollar for funding their Vostro account with Canada Bank, New Delhi. Assuming the interbank rates of US dollar is rupees 51.3625 slash 51.3700. First one is the bid and second one is the ask rate. Then what would be the rate Canada Bank would quote to ABN AMRO Bank? Further, if the deal is struck, what would be the equivalent US dollar amount? So here Canada Bank shall buy US dollar and credit rupees to Vostro account of ABN AMRO Bank. Canada Bank's buying rate will be based on the interbank buying rate, as this is the rate at which Canada Bank can sell US dollar in the interbank market. Accordingly, the interbank buying rate of US dollar will be rupees 51.3625 being the bid, that is lower of the two rates, and equivalent of US dollar for rupees 15 million at this rate will be 15 million divided by 51.3625, the rate, that is bid rate, and will be having US dollar amounting to 292,041.86 approximately. Now, Vostro account is the local currency account maintained by a foreign bank or branch. It is also called your account with us. For example, Indian rupee account maintained by a bank in Switzerland with a bank in India. So that is called Vostro account. So hope it is clear to you, because the question was what would be the rate Canada Bank would quote to ABN AMRO Bank. So obviously, the rate will be rupees 51.3625 being the bid rate, and what would be the equivalent US dollar amount? So equivalent US dollar amount will be 15 million divided by the exchange rate, that is the bid rate, that is 51.3625. Then total amount of dollar amounted to 292,041.86 approximately. We are coming to our next question. ABC Limited of UK has exported goods worth Canadian dollar 5 lakh receivable in 6 months. The exporter wants to hedge the receipt in the forward market. The following information is available. Spot exchange rate Canadian dollar 2.5 as compared to sterling pound, that is UK pound. Interest rate in UK 12% and interest rate in Canada it is 15%. The forward rates truly reflect the interest rate differential, means the difference between the interest rates. Find out the gain or loss to UK exporters if Canadian dollar spot rates, number one, declines 2%, number two, gains 4%, and number three, remains unchanged over next 6 months. So we have to give stress on the independent situations. That is, number one, declines 2%. That is, if Canadian dollar spot rates declines 2%, gains 4%, or remains unchanged over next 6 months. So by the by, looking into the question, our first task will be to calculate the forward rate by applying 2.50 multiplied by 1 plus 0.75. That is, if we are going to have, that is 15%, and this 15% is for 12 months, then for 6 months it will be 7.5%, which is equivalent to, that is 0.075. Now, let me repeat again. Forward rate we are going to have, the first we are going to consider 2.5, that should be multiplied by interest rate in Canada, that is 15% for the whole year. Then we are going to have 6 months, then it will be 7.5%, which is equivalent to 0.075. And if we are going to divide these with, that is 6%, that is 1 plus 0.060, then we get Canadian dollar 2.535. So that is the forward rate. Spot rate is given, and we have calculated the forward rate taking into account interest rate in Canada for 6 months and also interest rate in UK for 6 months, so that we can get the forward rate as Canadian dollar 2.535. Now we are coming to answer the questions. Remember, these questions are totally independent. So if spot rate declines by 2%, then spot rate will be 2.50 multiplied by 1.02. It comes to Canadian dollar 2.55 per UK pound. Now, UK pound receipt as per forward rate, that will be Canadian dollar 5 lakhs divided by the rate, that is forward rate, that is Canadian dollar 2.535. It comes to 1,97,239 pound. Then pound receipt as per spot rate, that is Canadian dollar divided by Canadian dollar, the amount divided by the rate, that is dollar 5 lakhs divided by Canadian dollar 2.55. Then it comes to 1,96,078, and accordingly, gain due to forward contract will be 1,161. Okay, so I think you have understood. Now you are coming to answer the second part. The second part is the forward rates truly reflect the interest rate differentials. Find out the gain oblique loss to UK exporter if Canadian dollar spot rates. We are coming to second independent situation, that is gains 4%. So if spot rate gains by 4%, then automatically it will be Canadian dollar 2.50 multiplied by 0.96, so that it will be Canadian dollar 2.40 per pound. Okay. Then dollar receipt as per forward rate, Canadian dollar 5 lakhs divided by exchange rate, that is Canadian dollar 2.535, that we have already computed. Okay. That give us to 197,239. And pound receipt as per spot rate, that will be Canadian dollar 5 lakhs divided by Canadian dollar 2.40, which comes to 208,333. Hence, loss due to forward contract will be the difference between these two, that is 208,333 minus 197,239. So it comes to 11,094. So if spot rate gains by 4%. Now, in the third part, it is given remains unchanged over next 6 months. So if spot rate remains unchanged, then pound receipt as per forward rate will be Canadian dollar 5 lakhs divided by exchange rate of Canadian dollar 2.535, that we have already computed, 2.535, as it is revealed, the forward rate. Okay, so it comes to 197,239. And pound receipt as per spot rate, that is Canadian dollar 5 lakhs divided by the exchange rate, that is Canadian dollar 2.50, that is given in the question. So it comes to 208,333. Now, if forward contract is actually being considered, then there will be a loss that is 208 333 minus 1,97,239. So loss due to forward contract will be 11,094. So we get all the three questions. That is, find out the gain or loss to UK exporter if Canadian dollar spot rates declines by 2%, gains 4%, or number three remains unchanged over next 6 months. Hope this is clear to all of you. Now we are coming to our next question. XYZ Bank, Amsterdam, wants to purchase rupees 25 billion against pound for funding their Nostro account. I'll inform you what is called Nostro account. And they have credited LORO account with Bancom London in London. So I'll inform you what is called LORO account. Calculate the amount of pounds credited. Ongoing interbank rates as per dollar, rupees 61.3625 and 61.3700, and per pound dollar 1.5260 slash 1.7000. After decimal, there are four numbers are to be written. Now we are coming to the answer. To purchase rupee, XYZ Bank shall first sell pound and purchase dollar, and then sell dollar to purchase rupee. So mind this. This is very, very important. To purchase rupee, XYZ Bank shall first sell pound and purchase dollar, and then sell dollar to purchase rupee. Okay. So accordingly, following rate shall be used. That is, pound rupees ask. The available rates are dollar pound bid. That is dollar 1.5260. Then dollar pound ask 1.5270. It is given in the question. Then rupees dollar bid, that is 61.3625 as it is revealed from the question, and rupees dollar ask, that is 61.3700, that is also given in the question. Remember, ask rate is more than the bid rate. Now, from above available rates, we can compute required rate as under. That is, pound rupee ask is equal to pound dollar ask into dollar rupees ask. So it will be 1 divided by 1.5260 into 1 divided by 61.3625. That is amounting to pound 0.01068, approximately four places after decimal, we are having pound 0.0107. Thus, amount of pound to be credited, rupees 25 millions multiplied by pound 0.0107, it comes to pound 267,500. Now, what is a nostro account? A nostro account is a bank account that a bank holds with a foreign bank in the currency of the country where the funds are actually being held. The term nostro is a Latin word that means ours, and it is used to facilitate foreign exchange and international trade transactions involving foreign currencies. Now, what is LORO? Loro? The word LORO is derived from the Latin word there. Loro account is the opposite, which means an account that one bank holds with another or third-party banks. So you have to remember these two terminologies, that is nostro, loro, and I've already told about, that is vostro. Now we are coming to our next question. JKL Limited, an Indian company, has an export exposure of JPY, means Japanese yen, payable 31st August 2001. Japanese yen, JPY, is not directly quoted against Indian rupee. The current spot rates, INR US dollar, is rupees 62.22 and JPY US dollar is equal to JPY 102.34. It is estimated that Japanese yen will depreciate to 124 level and Indian rupee to depreciate against US dollar to rupees 65. Forward rates for August 2021 are INR US dollar comes to 66.50, JPY per US dollar, that is JPY 110.35. Okay, required calculate the expected loss if the hedging is not done. So please give emphasis on the word hedging. In the last class, I have already told you, hedging is minimization of risk that will be arising out of foreign exchange exposures. So reduction, but no question of any 100% reductions. Only insurance is going to take into account or eliminate 100% risk. So the purpose of the hedging is to reduce the amount of risk involved. Now, as per the question, the first asking is, calculate the expected loss if the hedging is not done, how the position will change if the firm takes forward cover. Now, this date I am changing. If the spot rates on August 31st, 2021 are INR per US dollar, rupees 66.25, and JPY per US dollar is equal to JPY 110.85. Now, the question is the decision to take forward cover justified? So, we are required to justify whether forward cover should be taken or not. Okay, so we are having exchange rates given, spot rates, INR per US dollar and JPY per US dollar. And it is estimated that Japanese yen will depreciate to 124 level and Indian rupee to depreciate against US dollar to rupees 65. So we are having spot rates for August 2021 where INR per US dollar rupees 66.50 and JPY per US dollar, that is JPY 110.35. And the first question is, calculate the expected loss if the hedging is not done. How the position will change if the firm takes forward cover. That is the first part. And in the second part of the question, it is given if the spot rates on August 31st, 2021 are INR per US dollar, rupees 66.25, JPY per US dollar, it comes to JPY 110.85. Now we are required to substantiate the justification for the forward cover. Okay, now let us start with the solution. So please give kind attention because these are really confusing if you do not understand. If you don't have the proper knowledge, you are not in a position to solve the problem in the examination condition. So just see what will be the step-by-step approach to solve the problem. As it is given in the question, that is the direct code for yen and rupee is not available. So we are required to refer to, or it will be calculated by cross exchange rate, and that will be rupees per dollar multiplied by dollar per yen, so that we can have rupees per yen. So it comes to 62.22. 62.22 is given divided by 102.34, that is also given. It comes to 0.6080. Spot rate on date of export, 1 yen is equal to rupee 0.6080. Expected rate of yen for August 2021, that will be rupees 65 divided by yen 124, yen 124 Okay, yen 124. It is given. So it comes to 0.5242. Then forward rate of yen for August 2021, that is 66.50 divided by 66.50 divided by 110.35. That comes to rupee 0.6026. Okay, now we are going to answer the questions. Calculation of expected loss if there is no question of any hedging. So, heading should be calculation of expected loss without hedging. Firstly, value of export at the time of export, it will be yen multiplied by rate, that is rupee 0.6080. We are already having 1 yen is equal to 0.6080. Okay, it comes to 60 lakhs 80,000. Estimated payment to be received on August 2021, that is rupee 0.5242 multiplied by the total amount of yen, it comes to 52 lakhs 42,000. So loss will be difference between these two amounts, that is 60 lakhs 80,000 minus 52 lakhs 42,000. So virtually it comes to rupees 8 lakhs 38,000. So that is a hedging loss under forward cover. Now, hedging loss under forward cover, value of export at the time of export, total yen multiplied by the rate, that is 0.6080. It comes to 60 lakhs 80,000, as we have calculated in the first option also. Then payment to be received under forward cover, that is total amount of yen multiplied by 0.6026. That is 60 lakhs 80,000 estimated payment to be received in August 2021. That is 0.5242 into total yen, and amounting to 52 lakhs 42,000. Okay, so what we are having, value of export at the time of export, 60 lakhs 80,000. Then payment to be received under forward cover, that is 0.6026. This is the forward rate, 0.6026 multiplied by total amount of yen. It comes to 60 lakhs 26,000. So loss will be 54,000. But if there is a hedging, there was a loss to the extent of 8 lakhs 38,000. But taking forward cover, the loss will be reduced to 54,000. Now we are coming to the last part of this question, that is the decision to take forward cover justified? So, actual rate of yen On August 2021, it comes to rupees 66.25 divided by yen 110.85. 110.85 is given. Now we are going to calculate, that is 66.25 divided by rupees 66.25 divided by yen 110.85. The rate will be rupee 0.5977. Value of export at the time of export, that is total amount of yen multiplied by rupee 0.6080, it comes to 60 lakhs 80,000. Estimated payment to be received on August 2021, that is 0.5977 multiplied by total yen, it comes to 59 lakhs 77,000. So loss will be 1 lakh 3,000. Hence, the decision to take forward cover is still justified in order to reduce the loss. Hope you have understood. Now we are coming to the next question. You sold Hong Kong dollar value spot to your customer at 5.70 and covered yourself in London market on the same day when the exchange rates were US dollar 1 is equal to Hong Kong dollar 7.5880 and 7.5920. Local interbank market rates for US dollar were spot US dollar 1 is equal to rupees 42.70 and 42.85. First one is the bid, second one is the ask rate. Always remember. Calculate cover rate and ascertain the profit or loss in the transaction, and we have to ignore brokerage. Now, we'll come step by step. The bank, that is dealer, covers itself by buying from the market at market selling rate, that is rupee dollar selling rate, that is 42.85. That is the ask. Dollar to Hong Kong dollar, it is HK dollar, that is 7.5880. Okay, that is the bid rate. Then rupee Hong Kong cross rates will be rupees 42.85 divided by Hong Kong dollar 7.5880. It comes to rupees 5.6471. So profit oblique loss to the bank that we are going to calculate, there is amount received from customer, that is 1 crore into 5.70. It comes to 570,000,000. And amount paid on cover deal, 1 crore into 5.6471, it comes to 564,71,000. So profit to bank will be rupees 5,29,000. Okay, hope this is clear to everybody. Now we are coming to another problem. You, a foreign exchange dealer of your bank, are informed that your bank has sold a TT on Copenhagen for Danish kroner. TT means telegraphic transfer. On Copenhagen for Danish kroner, 10 lakhs. At the rate of Danish kroner, 1 is equal to rupees 6.5150. You are required to cover the transaction either in London or New York market, either in London or New York market. The rates on that date are as under: Mumbai, London, 74.3000 and rupees 74.3200. Mumbai, New York, rupees 49.2500, rupees 49.2625. London, Copenhagen, DKK, that is Danish kroner, 11.4200 and 11.4350. Mind that bid and ask rates. New York, Copenhagen, DKK, that is 7.5670 and 7.5840. Now the question is, in which market will you cover the transaction, London or New York? And what will be the exchange profit or loss on the transaction? And we have to ignore brokerages. So it is a very much relevant question because there are two markets. That is, one is London market, another one is New York market. And as per the asking of the question, in which market cover of the transaction should be made? And what will be the outcome? That is, what will be the exchange profit or loss on the transaction? And we are not considering the brokerages. So let us proceed. Let us proceed with the solution. Amount realized on selling Danish kroner, that is 10 lakhs at 6.5150. Okay, 6.5150. It is given in the question. So it comes to 65,15,000. Now, cover at London. Bank buys Danish kroner at London at the market selling rate. So pound sterling required for the purchase, that is DKK 10 lakhs divided by DKK 11.4200. 11.4200. It is given London, Copenhagen. So it comes to, that is Great Britain pound, 87,565.67. So bank buys locally Great Britain pound 87,565.67 for the above purchase at the market selling rate of rupees 74.3200. 74.3200. Okay. Okay. The rupee cost will be GBP 87,565.67 multiplied by rupees 74.3200. It comes to 65,07881. Accordingly, the profit will be 65 lakhs 15,000 as we have calculated minus 65,07881. It comes to rupees 7119. Now, over at the New York, bank buys kroners at New York at the market selling rate. Dollars required for the purchase of Danish kroner, TKK 10 lakhs divided by exchange rate given, that is 7.5670. 7.5670. Okay. So the amount in US dollar comes to 1,32,152.77. So bank buys locally US dollar 132,152.77 for the above purchase at the market selling rate of rupees 49.2625. Then the rupee cost will be US dollar 132,152.77 multiplied by 49.2625. 49.2625. Okay. So it comes to rupees 65 lakhs 10,176. Then profit will be 65 lakhs 15,000 that we have calculated. That is amount realized on selling Danish kroner. Okay. 65 lakhs 15,000 minus. Just now we have got 65,10176. So profit comes to 4824. Now, comparing the two situations, what we have found over at London, the profit resulted rupees 7119, whereas over at New York, the profit resulted rupees 4824. The transaction would be covered through London, which gets the maximum profit of rupees 7119 that we have already calculated, or lower cover cost at London market, that is 65,10176 that we have already calculated. Okay, minus 65,07881, that is rupees 2295. So accordingly, we are going to take the cover in the London market only. Hope this is clear to everybody. Now we are coming to our next question. Please try to follow the question. And this type of question, what we are doing right now, That is question number 7. It is of prime importance because these type of questions came in the examination many times. Now, what is given on January 28, sorry, on January 28, 2021, an importer customer requested a bank to remit Singapore dollar, in short SGD, 25 lakhs under an irrevocable letter of credit. So irrevocable means which cannot be revoked. However, due to unavoidable factors, the bank could affect the remittances only on February 4, 2021. So there is a time gap. That is 28 January 2021. But the bank could affect the remittances only on February 4, 2021. Now we are provided with the interbank market rates on both the dates, that is on January 28, 2021 and February 4, 2021. US dollar 1 is rupees 45.85 and 45.90. And in February 4, 2021, it is rupees 45.91 and 45.97. That is again bid and ask. Great Britain pound, 1 Great Britain pound on January 28, 2021, US dollar 1.7840 and 1.7850. And February 4, 2021, US dollar 1.7765 and 1.775. And again, the key. And again, so far, the Great Britain pound 1 as on January 28, 2021, that is Singapore dollar 3.1575 and 3.1590. And on February 4, 2021, Singapore dollar 3.1380 and 3.1390. The bank wishes to retain an exchange margin of 0.125%. So there is an exchange margin which should be retained by the bank. The percentage is 0.125%. And what is the requirement? Our requirement is how much does the customer stand to gain or lose due to the delay. And there is another thing is given in the question. Calculate the rate in multiples of 0.0001. Okay, so it is a good question. And we are having different rates on different dates. That is January 28, 2021. Okay, and February 4, 2021. So taking into consideration the problem, we have to have an importer customer requested a bank to remit Singapore dollar 25 lakhs under an irrevocable letter of credit, that is LC. But there is a delay. Although it is unavoidable, bank could affect the remittances only on February 4, 2021. So we are provided with the multiple rates in different currencies in January 28, 2021 and February 4, 2021. Now, how much does the customer stand to gain or lose due to the delay? So let us proceed with the solution. Please try to understand what solution we are doing. On January 28, 2021, the importer customer requested to remit Singapore dollar 25 lakhs. That is the main concept. To consider sale rate for the bank, US dollar, $1 we are going to take rupees 45.90. £1 is equal to US dollar 1.7850. All are asked. And £1 is equal to Singapore dollar 3.1575. So virtually 1 Singapore dollar will be 45.90 multiplied by 1.7850 divided by Singapore dollar 3.1575. Then we get 1 Singapore dollar rate, that is 25.9482. Exchange margin, that is 0.125%, which comes to 0.0324, and total is 25.9806. On February 4, 2021, the rates are $1 rupees 45.97. £1 is equal to US dollar 1.775. £1 is equal to Singapore dollar 3.1380. In the same manner, we get 1 Singapore dollar 45.97 multiplied by US dollar 1.775 divided by Singapore dollar 3.1380. So 1 Singapore dollar we get rupees 26.0394. And with this, we are going to add the exchange margin of 0.125%, which comes to 0.0325. So after adding this, we get 26.0719, and the previous one was rupees 25.9806. Hence, loss to the importer. So what the difference between these two rates are concerned, that is rupees 26.0719 minus 25.9806, okay, multiplied by total Singapore dollar 25 lakhs, it comes to rupees 2,28,250. Hope you have understood the solution. Now, just allow me 2 minutes time, and please look into the next question, which we are going to discuss in the context of foreign exchange and risk management. So please allow me 2 minutes. And please look into question number 8 and please try to understand what are the requirement of the question, and you have to judge in order to answer the questions what you are having in the uh, question itself. That is, with the help of, it's better to write rupees small. Okay, so kindly go ahead with this, read it. Then I'm going to discuss. Okay, just allow me 2 minutes, please. Yes. Now it is given the following two-way codes appear in the foreign exchange market. Now we are having spot and also we are having 2 months forward. Now, if you look into the spot rate, the first one is the bid, second one is the ask, and 2 months forward, first one is the bid, second one is the ask. And remember always your ask rate is greater than the bid rates. And if you look into the question, you'll find that 2 months forward rates have increased, both bid and ask. Now, the first requirement of the question is how many US dollars should a firm sell to get rupees 25 lakhs after 2 months? How many rupees is the firm required to pay to obtain US dollar 2 lakhs in the spot market? Assume the firm has US dollar 69,000 in current account, earning no interest, because on current account no interest is allowed. Then rate of interest on rupee investment is 10% per annum. Should the firm encash the US dollar now or 2 months later? So that is a decision-making situation. What is this? Should the firm encash the US dollar now or 2 months later? So let us proceed. Now, as per the requirement of the first question, it is asked how many US dollars should a firm sell to get rupees 25 lakhs after 2 months? So it is a simple phenomena. We are required to write US dollar required to get rupees 25 lakhs after 2 months at the rate 47 per US dollar. That is 2 months forward rate, the bid rate. So accordingly, rupees 25 lakhs will be divided by rupees 47, and the US dollar amount will be 53,191.489. Second question is, how many rupees is the firm required to pay to obtain US dollar 2 lakhs in the spot market? So rupees required to get US dollar 2 lakhs now at the rate of 46.25. That is the ask. Okay. Therefore, US dollar 2 lakhs into rupees 46.25, total amount comes to rupees 92 lakhs 50,000. Now, as the third part, it is given, assume the firm has US dollar 69,000 in current account earning no interest. Rate of interest on rupee investment is, or return on investment on rupee investment is 10% per annum. Should the firm encash the US dollar now or 2 months later? Okay, so it is a decision-making question. So, encashing US dollar 69,000 now versus 2 months later. It is better to write 2 months later. So, proceed if we can encash in open market, that is dollar 69,000, that will be multiplied by 46, the bid, it comes to 31,74,000. Then opportunity gain, that is for 2 months, that is 31,74,000 into 10 by 100 into 2 by 12. It comes to 52,900. And after adding these two figures, that is 31,74,000 plus 52,900, likely sum at the end of 2 months will be 32,26,900. Now, proceeds if we can encash by forward rate, then 69,000 multiplied by the bid, that is 2 months, 47, it comes to 32 lakhs 43,000. Sale of 69,000 on 2 months forward is recommended, as this approach will result in more amount of cash after 2 months. Now we are coming to our next question. Jet Limited importing goods worth USD 2 million requires 90 days to make the payment. The overseas supplier has offered a 60 days interest-free credit period and for additional credit for 30 days, an interest of 8% per annum. With an interest of 8% per annum. The bankers of Jet Limited offered a 30 days loan at 10% per annum, and their quote for foreign exchange is as follows. Spot 1 USD rupees 56.50, 60 days forward for 1 USD, that is 57.10, 90 days forward for 1 USD, rupees 57.50. Now, what is the question? Question is, you are required to evaluate the following options. Pay the supplier in 60 days or avail the supplier's offer of 90 days credit. Okay. So we are going to have calculation of total outflow if suppliers are to be paid in 60 days. Vis-a-vis, if we are going to have the suppliers offers of 90 days credit, then what will be the total cash outflow? And we are going to accept where there will be least cash outflows, that will be preferred. So in option one, we are having pay the supplier in 60 days. If the payment is made to supplier in 60 days, the applicable rate is forward rate for $1, that is 57.10. Payment due US dollar total, that is 2 million. Outflow in rupees, US dollar 2 million into rupees 57.10. It comes to 114,200,000. Then interest on loan for 30 days at the rate 10% per annum. It comes to 9,51,667. If you calculate, you can get. Then total outflow in rupees after adding interest on loan for 30 days, total outflow comes to 11,51,51,667. Now, when you are going to have the option to availing supplier offer of 90 days credit, then amount payable USD 2 million, 2 million, add interest on credit period for 30 days at the rate 8% per annum, which comes to 13,333. So total outflow in US dollar comes to 20,13,333. Applicable forward rate for 1 USD, that is 90 days forward for 1 USD, extremely sorry, is rupees 57.50. Then total outflow will be US dollar 20,13,333 into rupees 57.50. So total outflow in rupees, it comes to 115,766,648. Alternative one is better as it entails lower cash outflow. Hope you have understood. Now you are coming to next question. Just have a good look. The US dollar is selling in India at rupees 55.50. If the interest rate for a 6 months borrowing in India is 10% per annum and the corresponding rate in USA is 4%. Okay, do you expect that US dollar will be at a premium or at discount in the Indian forex market? What will be the expected 6 months forward rate of US dollar in India? And number three, what will be the rate of forward premium or discount? Okay, so looking into the question, remember it is given if the interest rate for a 6 month borrowing in India is 10% per annum and the corresponding rate is USA is 4%. So from this, we may say that under the given circumstances, the USD is expected to quote at a premium in India as the interest rate is higher in India. So mind this language. This is important for you. under the given circumstances, the USD is expected to quote at a premium in India as the interest rate is higher in India. Now, we can apply this formula 1 plus R suffix H divided by 1 plus R suffix F, that equal to F suffix 1 divided by E suffix 0, where RH is home currency interest rate, RF is foreign currency interest rate, F1 is end of the period forward rate, and E0 is the spot rate. Now remember, it is given per annum basis, but here we are going to consider for a 6 months. So that's why it will be 1 plus 0.0 divided by 2 divided by 1 plus 0.04, okay, is equal to F1 by 55.50. The US dollar is selling in India 55.50. Here it is given 10% per annum, but the corresponding rate in USA is 4% is given. So F1 we get rupees 57.13. Then rate of premium will be 57.13 minus 55.50 divided by 55.50 multiplied by 12 by 6 into 100, it comes to 5.87%. So this is a problem. You have to practice it because these type of questions are often coming in the examination. And what I'll request you, please go ahead with the study materials and please thoroughly try to solve all the problems and solutions provided in the study material. Now we are coming to a new question where certain expected value and the probabilities are involved. In March 2021, the multinational industries make the following assessment of dollar rates per British pound to prevail as on 1/9/2021. Then dollar pound and the probability are provided. It is 1.60, probability is 0.15, 1.70, the probability is 0.20, 1.80, the probability is 0.25, 1.90, the probability is 0.20, and 2, the probability is 0.20. So total, if you add the total probability, it comes to 1. Okay. Now, the question is given, what is the expected spot rate for 1st September 2021? If, as of March 2021, the 6-month forward rate is $1.80, should the firm sell forward its pound receivables due in September 2021? So, if you look into the problem, it is given in March 2021, multinational industries make the following assessment of dollar rates. Okay, now based on the questions, that is second question, if as of March 2021, the 6 months forward rate is $1.80, should the firm sell forward its pound receivables due in September 2021? So first question that we are going to answer, and based on that, we are going to answer the second. Now, the first question is, what is the expected spot rate for 1st September 2021? So, we are writing calculation of expected spot rate for September 2021. So, dollar for pound, then probability, then expected dollar pound. So, column 1, 2, and third one is column 3 is equal to 1 into 2. So, the rates which are given or provided in the questions, we have jotted down. Probabilities which are supplied in the question, we have jotted it down. Then we are going to multiply to get the expected dollar per pound and add it. Then we get summation, that is the mean, that is expected EV. Therefore, the expected spot value of dollar per pound for September 2021 would be dollar 1.81. Okay. Now, the first question is already answered. Now, again, I am looking into the second part. If as of March 2021, the 6 months forward rate is dollar 1.80, now the question is, should the firm sell forward its pound receivables due in September 2021? So, definitely, we are not going to consider this dollar 1.80 because the expected value that we have got, that is dollar 1.81. Okay, so if the 6 months forward it is dollar 1.80, the expected profits of the firm can be maximized by retaining its pounds receivable. Hope you have understood. Hope you have understood the question. Now we are coming to our next part. A company operating in Japan has today effected sales to an Indian company, the payment being due 3 months from the date of invoice. The invoice is 108 lakhs yen. At today's spot rate, it is equivalent to rupees 30 lakhs. It is anticipated that the exchange rate will decline by 10% over the 3 months period, and in order to protect the yen payments, the importer proposes to take appropriate action in the foreign exchange market. The 3 months forward rate is presently quoted as 3.3 yen per rupee. You are required to calculate the expected loss and to show how it can be hedged by a forward contract. Okay, so whatever information that we gather from the question, that we are going to first jot it down to solve the problem. So spot rate of rupee 1 against yen, that will be 108 lakhs yen divided by rupees 30 lakhs. So it comes to 3.6 yen. 3 months forward rate of rupee 1 against yen is given 3.3 yen. Anticipated decline in exchange rate is equal to 10%. So expected spot rate after 3 months is 3.6 yen minus 10% of 3.6. It comes to 3.24 yen per rupee. So After doing these calculations, it is better to write. After doing this, present cost of rupees 1 lakh, 108 lakhs yen is 30 lakhs. Cost after 3 months, 108 lakhs yen divided by 3.24. That we have already got 3.24 yen per rupee. So it comes to 32.73. So expected loss is 2.73. So what is the suggestion that we can refer? If the exchange rate risk is not covered with the forward contract, the expected exchange loss is rupees 3.3 lakhs. This could be reduced to rupees 2.73 lakhs if it is covered with forward contract. Hence, taking forward contract is suggested. I think you have understood the question and also its solution. Now we are coming to our next question. Just read it. ABC company has taken a 6-month loan from their foreign collaborators for US dollar 2 million. Interest payable on maturity is at LIBOR. LIBOR means London Interbank Offer Rate plus 1%. Current 6 months is LIBOR, 6 months LIBOR is 2%. Inquiries regarding exchange rates with their bank elicit the following information. Spot USD1, that is 48.5275, 6 months forward, rupees 48.4575. Now, number one, what would be their total commitment in rupees if they enter into a forward contract? And in the second part, it is given, will you advise them to do so? Explain giving reasons. Now, let us proceed. Firstly, the interest rate is calculated at 3% per annum for 6 months. Okay? Because if you look, interest payable on maturity is at LIBOR plus 1%. So current 6 month LIBOR is 2. So 2% plus 1%. Total comes to 3% per annum, but it is for 6 months. So firstly, the interest rate is calculated at 3% per annum for 6 months. That is US dollar. That is US dollar 2 millions into 3 by 100 multiplied by 6 by 12. It comes to US dollar 30,000. Now, from the forward points quoted, it is seen that the second figure, you just have a look, spot 1 USD rupees 48.5275 and 6 months forward is rupees 48.4575. So, from the forward points quoted, it is seen that the second figure, that is 48.4575, is less than the first, This means that the currency is quoted at a discount. So the value of the total commitment in Indian rupees is to be calculated as principal amount of loan USD 20 lakhs, add interest 30,000. So amount due 20 lakhs 30,000. Spot rate 48.5275 minus forward point 6 months, because forward rate is given 48.4575. That is, there is a reduction of 0.0700. Okay, so that we get forward rate as 48.4575. Okay, value of commitment will be, that is 20 lakhs 30,000 multiplied by 48.4575. So it comes to 983,68725. Now, will you advise them to do so? Explain, giving reasons. It is seen from the forward rates that the market expectation is that the dollar will depreciate. If the firm's own expectation is that the dollar will depreciate more than that what the bank has quoted, it may be worthwhile not to cover forward and to keep the exposure open. If the firm has no specific view regarding future dollar price movements, it would be better to cover the exposure. This would freeze the total commitment and insulate the firm from undue market fluctuations. In other words, it will be advisable to cut the losses at this point of time. Given the interest rate differentials and inflation rates between India and USA, it would be unwise to expect continuous depreciation of the dollar. The US dollar is a stronger currency than the Indian rupees based on past trends, and of course, it would be advisable to cover the dollar. So that is the correct and proper answer for the question. Now we are coming to next question. Excel exporters are holding an export bill in United States dollar 1 lakh due 60 days hence. They are worried about the falling USD value, which is currently at rupees 45.60 per USD. The concerned export consignment has been priced on an exchange rate of rupees 45.50 per USD. The firm's bankers have quoted a 60-day forward rate of rupees 45.20. Now, what is the question? Question is, calculate rate of discount quoted by the bank. The probable loss of operating profit if the forward sale is agreed to. So definitely we are going to take the difference between the two rates, that is 45.20. It is given in days, mind that, and we are considering 1 year as 365 days. So we are writing 45.20 minus 45.60 multiplied by 365 multiplied by 100 divided by 45.60 into 60. It comes to 5.33%. So probable loss of operating profit will be 45.20 minus 45.50 multiplied by 1 lakh. It comes to rupees 30,000. Okay, we are coming to our next question. Airlines company entered into an agreement with Airbus for buying latest planes for a total value of French franc FF 1,000 million payable after 6 months. The current spot exchange rate is INR Indian rupees 6.60 to FF. The airlines company cannot predict the exchange rate in the future. Can the airlines company hedge its foreign exchange risk? Explain by examples. Now, in this type of question, you have to make certain assumptions, and whatever the facts and figures that will be provided to you, with that, you have to proceed. So here, you are required to apply your own understanding of various modes of hedging. So the correct answer would be airlines company can hedge its foreign exchange risk by the following ways. Number one, hedging through forward contract. The company can take full forward cover against foreign exchange exposure and entirely hedge its risk. It can contract with bank to buy FF forward at an agreed exchange rate. Namely, for example, suppose the 6 months forward rate is INR 6.77 flash FF. This figure you have to assume the liability is fixed and the airlines company can concentrate on operation. Coming to number two, foreign currency option. Foreign currency option is the right, not an obligation, to buy or sell a currency at an agreed exchange rate, that is exercise price, on or before an agreed maturity period. The right to buy is called a call option and right to sell is called put option. Assuming that the airlines wants to purchase a 6 months put option, the put option exercise rate, say, is INR 6.70. The airlines will be required to pay a premium for purchasing the option, assuming 5% of the value of put option. That is, we can have 6700 multiplied by 0.05, it comes to 335. Maximum final cost 6700 plus 335, it comes to 7035. Suppose at the end of 6 months, the exchange rate at INR 6.88/FF, airlines will exercise its put option and hence it will pay INR 6.7. The exercise price to obtain 1 FF in this market, it will be required to pay INR 6.80. We are assuming, okay? Suppose the exchange rate at the end of 6 months is INR 6.35. Airlines should not exercise this option. In the open market, it need to pay only INR 6.35 instead of INR 6.70 to buy 1 FF. But option premium that is actually being paid, it is paid and it is a dead loss. Number 3, money market operations. Airlines can borrow in Indian rupee an amount and get it converted in FF at spot rate. This amount can be invested in France for 6 months so that this amount along with interest due on it becomes equal to FF's 1000 million and is used for making the payment. The loan in Indian rupee can be repaid back after 6 months along with the interest due thereon. Now, there is a theory called interest rate parity. If interest rate parity holds, the difference in the forward rate and the spot rate is a reflection of the difference in the interest rates in two countries. Thus, airlines will be able to hedge against the changes in the exchange rate. The problem with money market is that all markets are not open and all countries are not fully convertible. So, and all currencies are not fully convertible. Okay? So, it is totally based upon your conception or perception. We have applied certain facts and figures as it is given in the problem and we have assumed something and we can hedging through forward contract, foreign currency option and money market operations. We are coming to our next question. An Indian importer has to settle an import bill for $130,000. The exporter has given the Indian exporter two options. Pay immediately without any interest charges. Pay after 3 months with interest at 5% per annum. The importer's bank charges 15% per annum on overdrafts. The exchange rates in the market are as follows. Spot rupees per dollar 48.35 and 48.36. 3 months forward rate rupees per dollar 48.81 and 48.83. The importer seeks your advice, give your advice. So this is a question which is an open question where you are required to give your advice. Okay? So Indian importer has to settle an import bill for $1,30,000. So that is the amount concerned. The exporter has given the Indian exporter two options: pay immediately without any interest charges, pay after 3 months with interest at 5% per annum. The importer's bank charges 15% per annum on overdrafts. The exchange rates in the market are as follows: spot and 3 months forward rate are given. So the importer seeks your advice and you have to give your advice. If importer pays down, he will have to buy US dollar in spot market by availing overdraft facility. Accordingly, the outflow under this option will be $1,30,000 multiplied by, that is 1,30,000 multiplied by 48.36. It comes to 6,286,800. Overdraft interest for 3 months at the rate 15% comes to 235,755. So total comes to 6,522,555. If importer makes payment after 3 months, then he will have to pay interest for 3 months at the rate 5% per annum for 3 months. For 3 months, it is better to write 3 months along with the sum of import bill. Accordingly, he will have to buy dollar in forward market. The outflow under this option will be, that is, amount of bill and interest for 3 months at the rate 5%. So total will be $1,31,625. Amount to be paid in Indian rupee after 3 months. After 3 months, under the forward purchase contract will be US dollar 131,625 multiplied by 48.83. That is given. So it comes to 6427249. Now we are having two figures, 652,255 and 6427249. So cash outflow is list in the second option, and hence the same should be adopted. Now we are having the last problem over here. DEF Limited has imported goods to the extent of $1 crore. The payment terms are 60 days interest-free credit. For additional period of 30 days, interest at the rate of 7.75% per annum will be charged. The banker of DEF Limited has offered a 30 days loan at the rate of 9.5% per annum. Their quote for the foreign exchange is as follows: spot INR US dollar 62.50, 60 days forward rate INR US dollar 63.15, 90 days forward rate INR US dollar 63.45. Which one of the following option would be better? Pay the supplier on 60th day and avail bank loan for 30 days. And number two, avail the supplier's offer of 90 days credit. So if pay the supplier in 60 days, if the payment is made to supplier in 60 days, the applicable forward rate for 1 USD is rupees 63.15 as given in the question. Payment due USD 1 crore, outflow in rupees, USD 1 crore into rupees 63.15 crores. Had interest on loan at the rate 9.5% per annum, it comes to rupees 0.50 crores. So total outflow will be 63.65 crores. Availing suppliers offer of 90 days credit, amount payable US dollar 1,000 crores, add interest on credit period for 30 days, that is 7.75% per annum. Total outflow in USD, that is 1.00646 crores. Applicable forward rate for $1 as given 63.45. So total outflow in US dollar 1.00646 crores into 63.45. It comes to 63.86 crores. So option 1 is preferred. Now I'm just going to say something to you before I close today. Next class we are solving, we'll be doing lease, and that is leasing decisions. And what is my suggestions to you? Please try to focus on the entire syllabus and whatever given in the study materials, both theory and practicals. Okay, and please try to understand the basic perception or concepts which are required to solve the examination problems. Please don't try to mark, try to understand, and it requires some practices. So far, my knowledge is concerned, if you are not going to practice, especially in the form of writing, then you are not in a position to complete the paper. And you will say that, sir, paper was very lengthy. But in a final level of CMA, what is needed? Accuracy, perception, and speed, and time management in the examination hall. Okay, so that is very, very important. And whether you are going to answer any question on strategic financial management, please do the necessary workings, notes, assumptions, as and when it is required. Okay, without proper explanations, without proper workings, you are not supposed to provide the reward. So keeping in this in your mind, you have to, because strategic financial management is a dicey subject, I'm telling you, and your main focus will be on capital budgeting, both capital budgeting under certainty, uncertainty, risks, special emphasis on sensitivity analysis. You have to give on preference on mutual funds, then portfolio management, including security analysis, foreign exchange exposure, risk management, including options, then leasing decisions. Okay, so questions will be coming from these. So at the last, I will say, please do practice in writing. Okay, so if you read only, that is not going to help you. So with this message, I'm just going to close today. Thank you and see you in the next class. Goodbye.
Thank you, sir.
Thank you.